14 of 21 series are aligned with an acceleration mild environment this morning. That is a moderate level of systematic agreement across the framework. The current macro regime is acceleration mild, with a confirmation score of 14 out of 21. In this configuration, the macro regime reflects growth momentum and inflation momentum, both accelerating at the margin. Mathematically, the growth composite is running at an acceleration value of about plus 0.04, while the inflation composite is accelerating near plus 0.01, both measured as rates of change in the underlying series rather than as forecasts. The coherence score is moderate, indicating that not all layers in series are synchronized, but enough are aligned to give the regime reading substance. By our framework's reckoning, regimes with a confirmation score in this range have persisted in roughly 47% of comparable 3-month windows, with the most common next environment historically being a stagflation-type state, where growth softened while inflation stayed firm. Compared to last week, the engine is observing a modest softening in growth momentum inside the same overarching regime, even as the inflation composite has held its acceleration signature. Historically, environments like this have felt like a push-pull across markets. Commodities and energy prices often firmed, bond markets frequently wrestled with upward pressure on yields, and inflation-sensitive real assets drew more attention. A record of past behavior, not a roadmap. Let's walk through 4 signals inside that backdrop, starting with interest rates. The 10-year Treasury yield sits above the 2-year with a curve that has moved back toward positive territory, while the 30-year yield near 5.21% anchors the long end. This rates complex is tagged green on momentum, defined as a positive rate of change where long yields are pressing higher relative to recent history. Markets watch this because sustained moves at the long end often reflect changing views on inflation and term risk, even when near-term policy expectations have cooled. The question investors usually ask themselves in this setup is whether higher long yields change how much duration or interest rate exposure they are comfortable carrying. In our framework's reading of comparable periods, this roughly coincided with bonds struggling and more inflation-sensitive sectors taking relative leadership within 1 to 3 month windows, an observation under our methodology, not a forecast. What would challenge this read would be a clear reversal in long yields, combined with inflation readings that stop accelerating and begin to decelerate on a rate of change basis. Second, labor and employment. Non-farm payrolls, weekly jobless claims, and the unemployment rate feed into a labor composite that is currently marked red, meaning unfavorable momentum defined as a negative rate of change, even if the absolute level of employment remains solid. Markets watch labor data because it sits at the center of income, demand, and policy sensitivity. Softer hiring or rising claims can shift how participants think about growth resilience and central bank tolerance for tighter conditions. The question that tends to surface here is whether a cooling labor backdrop alters comfort with cyclical exposure or leverage. In our framework's reading of comparable periods, this roughly coincided with lower regime confidence and more uneven equity performance over subsequent weeks. A record of past behavior, not a forecast. What would challenge this read is a renewed acceleration in job creation and a decline in claims that lifts the composite back toward neutral or green. Third, credit. High-yield credit spreads. The extra-yield investors demand to hold lower-quality corporate bonds, are currently classified green for favorable momentum, defined as spreads narrowing on a rate of change basis. Markets watch this because tighter spreads historically lined up with confidence in corporate balance sheets and a comfort with credit risk. The question here is whether narrowing spreads confirm the pricing of equity risk or sit at odds with other macro signals like softer growth. In our framework's reading of comparable periods, this roughly coincided with steadier equity markets and less stress in funding conditions within 1 to 2 month windows. An observation under our methodology, not a forecast. A sharp re-widening in spreads, especially alongside higher volatility, would challenge this read. Fourth, equity sectors and commodities. Technology, healthcare, and financials are mixed to slightly softer, while energy and gold-linked assets show positive price action and upward momentum. Inside the framework, that cross-section is tagged with green momentum in commodities and parts of energy, defined as a positive rate of change in price structure, while several growth sectors screen yellow to red as their relative momentum cools. Markets pay attention because this kind of rotation tells them where recent flows have concentrated and how inflation-sensitive assets behave when the regime is characterized by accelerating price pressure. The question participants ask is how much sector rotation changes the balance of growth versus defensive exposure they are comfortable carrying. In our framework's reading of comparable periods, this roughly coincided with commodities and energy frequently leading performance tables, while long-duration assets were more volatile. A record of past behavior, not a forecast. What would challenge this read is a reversal in commodity momentum or a reassertion of strong leadership from growth sectors on a sustained basis. On the conditional map, two if-then triggers stand out. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions. In our framework's reading, inflation composites showed acceleration in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. In past environments, that configuration framed an expansion to acceleration transition, where markets wrestled with the question of how much additional rate pressure they were comfortable with inside their portfolios. If the Fear and Greed Index drops below 15 and holds for 5 sessions, in our framework's reading, the regime confirmation score deteriorated in roughly 7 of 9 comparable conditions, again a record of how the math behaved, not guidance on reaction. Historically, that mapped to regime watch phases where participants questioned whether price action still confirmed the underlying macro profile. The map is live. These conditions are being monitored daily across all 21 series. The Given engine is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework, price structure, rate of change, risk regime, and market participation across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, the engine records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside the engine. They are separate outputs. The regime does not pick the symbols, the 4 layers do. Members use the engine to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. The Given engine monitors 407 symbols independently of regime and runs the framework the same way every day. The Given engine is designed for potential insight into how conditions line up mathematically and for educational study of prior environments. The Given engine runs the framework. You study the outputs and environment. You decide what to do next. May. Every trading day, this is free. Watch real symbols go active in live markets at the price it's happening. See which sectors are leading and learn to read what's driving it yourself. That live view is the observation desk, the same 21 series and 407 symbols founding members study each morning. The environment underneath every move. If you want to watch it alongside us, the live view is at givenanalytics.com. Free to try, no credit card, for the first 500 founding members. Watch it before you risk $1. You decide.